everyone, and thank you to those of you who are joining us today. We're very excited to be part of this year's Financial Inclusion Week discussions and to be participating in this special event that brings so many people together to share ideas in an effort to chart a better path forward. My name is Andre Simone. I am the president and CEO of Finca International, and I'm extremely pleased to be joined today by Greta Bull, the Director of Women's Economic Empowerment at the Bill and Melinda Gates Foundation. Thank you, Greta.
Thank you for having me. I'm looking forward to the discussion.
Excellent. So we only have 30 minutes. You and I both talk fast. There's been quite a bit of discussion lately around the topic of subsidy for microfinance. And we have participated in a lot of those discussions. There was one, in fact, two now, hosted by FinDev Gateway and the Financial Access Initiative, FAI, both of which talked about, well, what do we need to do to drive more impactful microfinance? I want to pick up on some of the questions that we talked about in those previous dialogues, but really dig into them even more here. So that we can keep this conversation not only really front and center for everybody, but also continue to deepen it so that we're really driving change in how we deliver services to marginalized women entrepreneurs. So during our previous conversations, we all agreed that subsidy does in fact have an important role to play in developing better solutions, and that at the same time, there are specific focus areas that need to really be a part of that focus for us. There are three dimensions that I wanted to talk about today. One of them is the cost of funds, which is something that we talk about a lot. One of them is technology and the role of subsidy in technology. And then the last one is targeting of specific client groups. So I guess, just to start off, I'll take the topic of cost of funds because that is one that we do talk about frequently. And you are well aware of the fact that it's extremely expensive for microfinance institutions to borrow in the countries that they operate in. In the case of Finca, as a case in point, in Zambia, it costs us 28% to borrow in local currency. In Uganda, it's around 18%. And so, that's the baseline that institutions are starting from before they've even developed any services that they're going to deliver to their customers. So you've pointed this out before. There are a lot of different factors that contribute to that high cost. How do you think subsidy could help?
Well, let me start out by level setting on 2 points, actually. One is, what do we mean by more impactful? To me, more impactful really sits around a couple of dimensions. One is products that meet clients where they are with what they need. So it's products that match their cash flows. It's products that help them buy an asset. It's products that are affordable, and products that grow with them as they grow, right? And I think those are all, and the evidence base, by the way, is very clear on this. And so I think we have to be really thoughtful about what we mean by impact. But I also want to kind of pull apart your three dimensions in maybe a slightly different way. The cost of financial services is driven by three things. It's the cost of funds, it's OPEX, cost of delivery, and it's the cost of risk, because you don't know what the likelihood of those customers are to repay, because they're probably zero data customers, right? And so if you break it down around cost of funds, cost of risk, and OPEX, you have to look at all those components differently, right? So I know we'll get to all of them, but let's talk about cost of funds, because I think it's important. And by the way, those three things are all intertwined, right? For example, tech is relevant in cost of funds. It's relevant in client targeting. But let's take cost of funds. I think the fundamental market failure is that, because particularly of the macro situation we're in Africa right now, risk is being fundamentally mispriced to low-income women in particular, but low-income people generally. So if the Kenyan government has to borrow at 20% because their macro situation is not happy, that means that gets cascaded down to everybody else in the market, and they're paying super high rates. Like interest rates upwards of 70% are pretty common in Kenya, if you can get a loan at all, right? And so I think we need to think about how we drive down those costs and correctly price for risk. So one big component of the cost of funds is the Forex cost. Right now, financial institutions in most African countries don't lend to MFIs
Right.
or NBFIs. You guys have to go outside of the country to source that money. And so hedging costs in the market environment we're in today are obscenely high. So first of all, like, why are we all dependent on external financing? That seems like problematic to begin with and might help explain some of the debt situation that we're in. But why are we paying such high premia to borrow from, different DFIs? And so I think one of the things we're trying to do is think about how we connect second and third tier financial institutions like FINCA, like BRAC, like NBFIs, fintechs like MCOPA, with local sources of financing. And we're looking at doing that in a couple of ways. Can we use first loss guarantees to drive down the cost of funds? So we're exploring this with you, in fact, in Uganda with another banking partner. Can't say who yet, but if we put in first loss guarantees, can we use that to drive down the cost? Because they're not having to hold capital at the same level. And that's local currency money because, big banks in Africa have plenty of liquidity. They're mostly lending it to government right now. And so like first loss guarantees can be a mechanism, but we're also interested in exploring whether securitization can be a way of crowding in those, those local currency lenders. So what about the pension funds and the insurance companies? They're mostly not that engaged in the local market. Can we put policy choices in place that would encourage them to do that? Can we help drive down the cost of securitization? Because if you're the first guy to do it, it's super expensive. So there's a case to be made for a kind of infrastructure that would enable securitization where patient capital or donor money even would come in and sort of standardize everything so that everybody can use that facility and securitize, because then you're kind of packaging AAA or AA or whatever rated security that you want into the local market. And that's a way of crowding in not just banks, but also the pension funds and the insurance companies who really aren't making a dent in any of these markets. So there's a ton of untapped capital that could be unlocked with very strategic deployment of policy choices, some donor funding, and some risk sharing, right?
Yeah.
So I think there are answers to that, and we're trying to explore some of them because right now the cost of capital is ruinous in Africa.
It is ruinous, yeah, and of course it's the customers that are ultimately bearing the brunt of that. And actually that kind of gets me to exactly the next thing that I wanted to ask you to talk about in some ways, which is actually in a previous conversation that we were having, you were talking about how great it is that the VSLAs and the SACOs still exist. And truly, they cost so much less for people to use because they're paying for their own money and paying each other back for that. And so, the question is, those are fantastic. They have a much lower cost of funds. Does that mean that microfinance isn't needed and we should just pack up?
No. You might be surprised to know that that's my answer.
Yeah.
So in the 3 years I've spent at the foundation, I've spent a lot of time digging into self-help groups, SACOs, VSLAs. And it's been really eye-opening because I spent all my life in commercial microfinance and digital financial services before. And the interesting thing about VSLAs and SACOs is that's where women tend to be. Women are less likely to be in microfinance. They're definitely less likely to be in banks. So they cluster in these informal credit ecosystems. And you're right, there are some advantages to those informal credit ecosystems. They're a lot cheaper. You have a lot more control. It's managed through social relationships, all the things, right? But they have some downsides too. You have to wait your turn, and you're limited by the amount of money that groups can save. And so there are some limitations, right? So I think as a resilience tool, they're pretty helpful.
Yeah.
I think as a growth tool for an entrepreneur who just needs money when they need it, on terms that they need it on, they're kind of constraining.
Yeah.
SACOs, I think, are a little bit different, but similar. They're a little bit more robust, depending on the SACO. And you can probably borrow larger amounts, but some of them are limited membership entities only, or pretty selective about who comes in. And so I think they're important. By the way, I should say for the record, I think all the things matter. I think banks matter. I think non-bank financial institutions matter. I think MFIs matter. I think VSLAs and others matter. I even think digital consumer lenders matter, believe it or not, because we have very high cost consumer credit here too. It's called a credit card, and they play a pretty important resilience function. And so I think we need all of those things, but they need to be stitched together in a more sort of interconnected ecosystem that meets people with what they need,
Yeah.
where they need it, when they need it.
Yep. So basically, then, and I don't want to put words in your mouth, not that I ever could, but you're talking about, on the one hand, there needs to be a much more concerted effort to bring our sector together around systemic and subsidy injections, systemic changes in subsidy injections that can actually lead to a lower cost of funds for target populations, one. And then two, microfinance institutions have to be able to build a bridge for very small borrowers and entrepreneurs from those VSLAs and SACCOs and kind of the informal systems and quasi-formal systems that exist to the commercial sector. And that really is ultimately the role that MFIs have to play. But
Can I
yeah,
shamelessly plug a white paper that we put out last spring in advance of spring meetings? You knew I was going to do this, but like that's exactly what we think, and we sort of have this step model for capital that banks are up here. That's where all the money is. Ultra poor graduation even and VSLAs kind of sit down here, and that's where women cluster. And our whole strategy is around what does it take to move women up that ladder and move money down that ladder. And we think it's an ecosystem problem, right? You're not going to digitize your way out of this, as I said in the thing the other day. It's yes, digitization is important across all these elements, but it's also going to require better policy environments. It's going to require the availability of local currency, low cost funding. It's going to require better institutions. So in a way, the burden is on you guys. One thing that can really help bring down the cost of borrowing, in addition to lowering the cost of funds, is for you guys to get a lot bigger.
bigger.
And we cover that in our white paper, so check it out.
I support your shameless plug, and I guess what I'll layer on top of that is also the urgency around the speed with which we solve this particular issue, right?
Yeah.
Because we know that in fact people are very much at risk of falling back into poverty. That we haven't actually made very much progress, particularly in sub-Saharan Africa, whereas in China and India and some other places, I think we have, and we're seeing a lot of unrest and migration and climate related issues and food security issues that are only making that crisis worse. And one of the ways that we solve that is by unlocking that capital flow down, as you were saying. So, okay, so let's come back to what we need to do better on the delivery side, because I think that is an incredibly fair point. So let's talk a little bit about technology, if we could, because as you know, and we definitely agree on, certainly we understand that technology is not the panacea, right? It's just like microfinance wasn't the silver bullet. Technology is not the silver bullet. Fine. But we really do have to acknowledge that digitization and automation is going to be crucial to not only improving the cost paradigm, but also the flexibility and customization that's needed to drive that impact that you were talking about and clarifying in the beginning.
Yep.
And we're not going to be able to measure our performance very well if we don't have that digitization and automation. So we've got to get to that. But and not everything is necessarily good about digitization and automation. So can you, for a second, just from your perspective, talk about what about it do you think is good for institutions and customers, and what is maybe not so good?
Okay. Oh, that's a big question. Digitization can play a role across all three of those dimensions that you talked about, right? Or call it OpEx, obviously. I mean, if you can digitize and you can get some of the high cost of people out of the mix, and people cost a lot in Africa, compared to like Latin America or Asia. Digitization of back office functions, just kind of getting smarter about how you store data, how you capture customer data. That leads into your client targeting and your cost of risk question too. Like I have been saying, I don't know, for over a decade, hey, MFIs, you need to start digitizing your data. I used to go look at MFIs and they would have literally stacks of paper. It's like, you got a gold mine there. Like, but you don't have to digitize all that old stuff. Just start now, start understanding what your customers are doing, because like MFIs lose customers because you give them the same old cookie cutter products over and over and over. And if I've paid you back multiple cycles, why am I still getting the same really expensive, inflexible terms and conditions? So having better kind of tech and better data will enable you to do risk-based pricing, to do better products, to retain those clients, which will help you to get bigger, which is ultimately going to be a thing that drives down interest rates, right? And so I think Tech is going to be important in both those areas. Tech is also going to be important in cost of funds. Like as we think about some of the work we're trying to do on securitization, we've learned a lot from Northern Arc in India and from a partner we have called Kaleidofin, whose founders were part of the founding team in Northern Arc as well. And so what they do is they connect data at the originator end with structured finance that enables them to kind of securitize into a vehicle and get stuff off their balance sheet so they can continue to grow. And it's you can rate those securities because you can see exactly what's in that portfolio and then you can sell it into the market. We don't have that in Africa. And so we need to build it. But so even in cost of funds, I think technology will play a huge role because there's so much we can see if we digitize this stuff properly. Now, where can it go wrong? Well, gosh, let me count the ways. So, I've been in this business for a long time, and frankly, I have seen MFIs get this wrong over and over and over again. So how do they get it wrong? They get it wrong because some donor dangles some money in front of them and says, "Oh, digital," and they run off chasing after that thing, whether it makes sense or not. That's one common pitfall. Second, they don't have the right people to deliver it. You need good skills. Third is they want to be an M&O, which they're not. And so why are you doing that thing? So I think and fourth is like, you don't have agreement up and down the institution, right? You need solid agreement from your board all the way down because tech lifts are massive change management exercises. And actually, things have failed because people have gone, "Oh, wait, I might lose my job." And so I think being really strategic about tech investment, understanding that you're an MFI and not an M&O, and using that to sort of lower your costs. So you and I met, in fact, because we worked together on a project around that in the DRC, where you put in place agency banking, and it did amazing things because you understood that you were an MFI and not an M&O. And you managed the heck out of it. And so I think MFIs fail on this a lot. So I think we have to think about how we pay for those kinds of changes and make sure that everybody's on board and ready to go.
And just to add a little bit to what you were saying, I think that for sure one of the mistakes, and we've talked about this too, is that when we started on the digitization journey, there wasn't enough focus. It was almost like technology as a product, as opposed to what is the capability that we're going to deliver with this investment, right? And really looking at what the impact of that specific investment was going to have. And I guess that kind of leads in very nicely to the next question that I wanted to talk to you a little bit about. And again, something that we've discussed, but one of the challenges for microfinance institutions and small institutions generally is that it's just really expensive to invest in technology, and it's cost prohibitive when you're really small. There have been a lot of efforts to create more kind of open source or system level tools that institutions could use. Some of them have been around open source core banking programs or CRM programs, other shared platforms. And the results of that have been mixed. And so that at Finca right now, we are embarking on a big journey around how we want to leverage technology to lower the cost to serve, really significantly, but also be able to offer our clients products that line up better with their needs. And that is going to hinge on our ability to do the data analysis that you were talking about previously. The honest truth, though, is even inside our own organization, there's a lot of, I will say, healthy skepticism around our ability to really reach for this dream. And I think that's warranted given the experience that a lot of the sector has had, in particular, some of those bad investments that were made. But we also know that if we don't make those investments, we're not going to be able to deliver on the operational improvements that we have to deliver on in order to help our customers. So just to riff on that for a second, there are some things that organizations have to do alone, and there are other things that organizations like Finca maybe should rely on other partners to help set up. What are the things that you think we should be thinking about as an organization? Like, what do we need to do, and how should we be thinking about those investments in terms of the value that they're going to create for us and for potentially other customers?
Yeah, I think that's a great question. A few answers to that. I think the first thing is you need to know what you're doing it for, and you need to invest appropriately. And you need to invest for FINCA first and foremost. Like you can't design for somebody else. And so, I mean, I know the work that you're doing on digitization. I think it's important. And it's going to be a tough lift. It always is. Any kind of technology investment, and I think this is a place where donors. There is a role for subsidy, just helping MFIs get over that hump, but you can't do it for every single MFI, right? So interestingly, the foundation's very invested in the idea of digital public infrastructure, and there's a whole repository of digital public infrastructure. And you'll be amazed to know that some of those original core banking systems are in that repository. We were just ahead of our time, clearly. But I think there are systems that naturally lend themselves to cooperation or to public infrastructure. So an ID is clearly public, right?
Yeah.
A payment system is actually something that requires collaboration. So you
Yeah.
need sort of a third party to do it, and then people join, and then it gets complicated because you've got competitors cooperating, and what are the rules? How what does the business model look like? But it can work, and it is working in a lot of places. India is the best known one, but Brazil's built a system, and we're supporting this in a number of countries. I think when it comes to core banking, it may be worth revisiting. But core banking's super tricky, right? And how you manage it, I think be careful what you ask for. Data sharing infrastructure, I think, is a no-brainer.
Yeah.
But again, it's asking people to cooperate when they would normally compete. And so I think, part of what we're trying to do with partners like Kaleidofin is to build data infrastructure that can cut across multiple MFIs. They provide that service, so they effectively act as a data aggregator, and they provide dashboards, and then they also triangulate with the credit bureau, right? And we need to do a better job on credit bureaus and making sure everybody's reporting to credit bureaus. So I would put kind of data as the next thing. And the foundation is really interested in data infrastructure because credit underwriting is really impossible without data. And then, core banking, maybe we can tackle that again someday. But I think the trick is who's doing the work,
Yeah.
right? So I think if it's public infrastructure, donors have a really important role to play.
Yeah.
And that's an entirely appropriate role for subsidy. I think it's hard for you as FINCA to build that infrastructure for everybody else. A, because why would they give you their data?
Right.
And B, they're not sure that you're the right people to develop the system and all that stuff. So I think you first and foremost have to build for FINCA, and then you figure out everybody else later. And there may be, there is a lot of work going on around data sharing infrastructure and payment systems and all the things. There are also big competition policy issues because a lot of that data sits in MNOs in Africa, right? And figuring out ways to kind of get that out of silos, it's a bigger lift.
Yeah.
And so I think it will come, and I think there are donors who are really focused on this, but it'll take time.
Yeah, it's going to take time. On the other hand, the faster we get to that, the faster we get to things like risk-based pricing for the sector.
But that's you. That's you digitizing your own
Our data. Yeah.
and your data, because your customers. You've probably got better data on those customers than just about anybody.
Yeah.
And so that's what I just used to go mental going to the offices of MFIs and seeing paper folders where they also had amazing poverty data, and it was like sitting in a dusty file.
Yeah.
And so, I think sort your own house out, and then, but do it in a way that has, kind of the kind of flex that you get with middleware, so you can plug into something like a Kaleidofin solution, right? Because that's where the real benefit happens is if you have APIs and you can plug into a more nimble solution that sits at the center and allows you to share data with others, right?
With others. Yeah. I mean, and so we did in fact start, and this, but we did in fact start with exactly that. We took all of the customer data that we had, we layered on top of that all of the impact data that we had, and now we actually have kind of this ability to, at least for our existing clients, not only serve them faster and better, but also we have insights into how they're being affected by the credit that they have access to, right?
And by the way, financial data too, because one complaint I often hear from DFIs is it takes me so long to get the information out of MFIs. It's like pulling teeth.
Yeah.
So like if you could produce the financial data for them pretty quickly and in a timely way, that would also help on the funding side.
Yeah. Yeah, it definitely does. It definitely does. I think, and I have heard that same complaint, and I have to acknowledge that it's true.
Probably from the same people.
Yes, probably. All right. Well, only because we are running out of time, and I definitely want to ask you this last question, which I think is the third leg of the stool that we were talking about at the beginning, which is, How does subsidy help to drive outreach to the poorest populations? And I have, Finca currently is subsidizing customers below $1,000, and I think honestly that shocks a lot of people, right? That we're doing that, and we have other partners. BRAC, of course, is huge subsidy to the very poor customers that they're working
Yep.
with. But that's because we are mission-driven organizations, and we're making a concerted effort to reach people who are underserved, particularly women and smallholder farmers, et cetera. And those are the people that are borrowing those really small amounts. So one part of the conversation is how, in your view, does subsidy help us to reach those specific populations, and what's the benefit of it? But then on the flip side, there are some sources of subsidy, and it's a variety of different players who
Mhm.
are really only interested in these small, very hard to reach populations. And for institutions like Finca that are double bottom line, there's a real pain point that emerges around the distraction that it creates from a management perspective and a systems perspective, and a
Yep.
reporting perspective, to go after those small populations. But on the other hand, those are exactly the populations that we want to serve. So kind of, what do you think the role of subsidy in is that as well?
This is my favorite topic. So I'm going to plug shamelessly my white paper again, because this STEP model is precisely to talk about this question of targeting and matching instruments with the population. And so, ultra poor graduation is a whole thing. BRAC hangs that off of its microfinance operations, and actually they graduate about 65, between 50 and 65% of those UP destitute people that they kind of get on their feet. They go on to take loans from BRAC microfinance. Now, BRAC microfinance loans are cheaper than yours. So, like, the ultimate thing that you have to do, let me say it again, is get big, because BRAC also pays for 85% of all its work in Bangladesh through the retained earnings of BRAC Bank, BRAC Microfinance, Bcash, or Wrong, right? And so I think there's a lot of benefits of getting big if you haven't figured that out already. But the other thing that I think is interesting is the work that India is doing. And this is described in the white paper, in the SHG ecosystem, which is the Indian version of the SLAs. They operate a little bit differently, but I think this is a great use of subsidy. So let me just kind of explain how they do it. Impossible to do in 2 minutes, but um, it's a platform that organizes 100 million women, 100 million, catch that number, into self-help groups, and it channels money to them. So there's a certain element of self-savings, but there's also what they call capitalization grants. So a group forms, they do their own saving for 6 months, 3 months to 6 months, and they show they can do it. They do the 5 Ps, right? And then they're eligible for a capitalization grant. So that capitalization grant of like $380 gets sent out to the group free. You guys manage it, because you can't manage the risk of lower income, really low income borrowers and loans. Well, they can do it themselves. So if you're making grants, the money's out the door anyway. A capitalization grant cycles and accumulates interest. And if it's managed well, it actually functions almost like a little credit union, right?
Right.
And then because of the bank linkages program, these things get federated into kind of cluster level federations, is what they call them. But they use this to drive money from the banking sector into the SHG ecosystem. And they do it in a way that delivers that credit between 7 and 12%, right? And so there's a whole mechanism. You don't want to know the details, but like where banks, commercial banks, are funding into that ecosystem through the cluster level federations. It goes down to the self-help groups. And there are subventions. So the interest rate gets brought down. So the government pays the difference between the commercial rate and that set rate for the self-help groups. And so they're getting credit on really affordable terms. Now it's the same kind of not super flexible, not super friendly credit, but it's a heck of a lot better than what you can get from a microfinance institution. So it's almost like training wheels. Like, I am learning how to manage credit, and I am learning how to save, and I'm learning how to do all those things through this kind of system. And then I can start tapping into credit. Now what we're doing, speaking of digital systems, is we have now digitized. We've helped the Indian government. We haven't done it, but we've helped the Indian government to do it. We've digitized the credit histories and the administrative histories of those 100 million women. And because of Aadhaar, the ID, you can track both their repayment behavior as individuals and as groups. And then the idea is that they should be able to take this through the data infrastructure that exists in India to a commercial lender and then get an individual loan, right? So it's all about moving women up that path and moving capital down. And India's doing this in really interesting ways. And I think that's an appropriate use of subsidy. It's
Yeah.
hard to game the system. You know, everybody complains about distortion. Well, I mean, you got to be part of a group. That takes time. So like somebody's not going to come in and steal the money. You have to do the work. And so it's just a good way of kind of onboarding women. Now we're building something similar in Nigeria called Nigeria for Women in partnership with the World Bank. But you know, VSLAs are in Uganda, Chamas are in Kenya. So there are lots of opportunities to do this, but you've got to be able to digitize and show that credit repayment history,
Yeah.
move out of the group products and into the individual products. And then you guys are the bridge where you're trying to develop starter products, but then
Yeah.
better products. So that again, if I've, you know, repaid 6 cycles of loans with you, I get a better product
Yeah.
because I'm a good credit risk. And so it's all about this ladder of moving women up and capital down. And subsidy is crawling through that, but I don't see it distorting particularly.
Yeah, no, excellent. Thank you so much, Greta. So I am frozen, as you can
I
probably
can see
see.
that.
Yeah, and it's a really attractive pose. But at least you can hear me. And so I have been informed that we are at time, unfortunately. And I'd just love to do a recap with you because this was such a rich 30-minute conversation. And you know, I think that as a springboard for Financial Inclusion Week discussions, a really helpful one. So you know, the bottom line is this: one, with respect to lowering the cost of funds, there is a role that funders and donors in particular have to play, not only in organizing financial vehicles that will help to provide greater access at lower cost in local currency to institutions that are pro-poor, but also in directly contributing to the lowering of those costs by being a first loss guarantor or providing capital at a concessional rate in order to encourage that flow of funds. And we want to accelerate that for 2 reasons. One is because there's urgency around addressing this question of growing poverty, and we need to demonstrate that we can deliver greater impact. And you made a nice clarification at the beginning that it's really about putting more money into people's pockets that they can use productively. But 2, also, we want to scale these institutions to make sure that they are able to deliver at a lower cost and continue to drive that virtuous circle. And we maybe haven't fully digested some of the lessons of global microfinance in that really well capitalized institutions have a much better chance of being efficient and being able to lower the cost of services, whereas undercapitalized smaller organizations are potentially going to be caught in a perpetual loop that is not delivering great impact and also not delivering great sustainability. When we talked about technology, I think the points that you made were excellent around one, institutions obviously having the right people and the right plan, but also the right objective with their technology investments, but that there is no question that there is support that's needed in order to help microfinance adopt technology well. And that we really need to keep it very focused on core capabilities that are going to, again, drive the impact on the customer, as opposed to flashy bells and whistles that we don't necessarily create a lot of value from. And then the last part, really talking about how can subsidy be used effectively to drive targeting of more marginalized populations. And I think the example that you gave of India is a really helpful one for our industry to see overall, right? Because it requires the participation of all actors, the commercial institutions, the social impact institutions, the government, community. And I think that that's something that we need to aspire to universally. So you have been just an amazing interlocutor, and I appreciate you so much. And you're going to jump in and make one last point.
Can I say one last thing? Because
Yeah.
one point I want to make on the India thing is the value of doing this is that donors can massively leverage their investment, right? So if you look at India, a $15 billion investment in the administrative infrastructure, some capitalization grants, and some interest rate subventions has catalyzed $6 billion in savings from the women themselves, but brought in $120 billion from the banking system. That is massive leverage. And in a time when governments don't have a lot of spare cash, that's really important.
Yeah. Awesome. I'm trying desperately to see if I can flash my face for one last goodbye, but it looks like I'm perpetually frozen. Let's hope that that is not a sign of things to come. Thank you again, Greta, really a lot, and look forward to hearing all the follow-on discussions that come out of this conversation.
Sounds good. Thanks for having me.
Thank you.